This is part 2 of a series breaking down Jesse Livermore's book, How to Trade in Stocks, chapter by chapter. Everything you hear comes directly from his writing. His own words, his own observations, his own rules. No interpretation, no fluff. Just what Livermore actually said about speculation, applied to modern futures trading. Chapter 2 is about knowing when to exit, not hoping, not guessing. Watching for specific signals that tell you the trend is ending. Livermore called it the danger signal, and most traders ignore it completely. Here's what he learned after 40 years. Markets move in patterns, and when that pattern breaks, you get out. Livermore opened chapter 2 with this.
Stocks, like individuals, have character and personality. Some are high-strung, nervous, and jumpy. Others are forthright, direct, logical. One comes to know and respect individual securities. Their action is predictable under varying sets of conditions.
Markets have rhythm, and if you study that rhythm, you can see when something changes. Here's how he described a normal trend.
At the beginning of the move, you will notice a very large volume of sales with gradually advancing prices for a few days. Then what I term a normal reaction will occur. On that reaction, the sales volume will be much less than on the previous days of its advance.
Normal reactions, small pullbacks, lower volume. That's healthy. Then Livermore gave a specific example.
Take a stock that starts at 50. On the first leg of the movement, it might gradually sell up to 54. A day or two of normal reaction might carry it back to 52.5 or so.
Translate this to ES. Starts at 4,200, moves to 4,280, pulls back to 4,250. About 30 points on declining volume. Normal.
3 days later, it is on its way again. In that time, it might go up to 59 or 60 before the normal reaction would occur. But instead of reacting, say, only a point or a point and 1/2, a natural reaction from that level could easily be 3 points.
ES pushes to 4,380, then pulls back 60 points. Bigger reaction, but proportional to the bigger advance. Still normal. Here's the critical part.
The stock could easily go from the previous high of 60 to 68 or 70 without encountering a natural reaction.
ES accelerates from 4,380 to 4,540. Vertical move. Barely any pullbacks.
When that normal reaction does occur, it could be more severe. It could easily react down to 65 and still have only a normal decline.
ES drops 100 points from 4,540 to 4,440. Looks scary, but it's proportional to the parabolic advance. Still normal. This is the pattern. Each leg gets bigger, each reaction gets bigger, but it's consistent. You learn the rhythm, and when the rhythm breaks, you know something changed. Livermore didn't just watch price. He watched volume. He wrote,
When it resumes its advance again in a few days, you will notice that the volume of sales at that time is not nearly as large as it was at the beginning of the move. The stock is becoming harder to buy.
Volume declines on new highs. Supply is drying up. That causes acceleration, but it's also a warning. Then this happens.
The stock starts up again, and it has a rise of 6 or 7 points in one day, followed the next day by perhaps 8 to 10 points, with great activity. But during the last hour of the day, all of a sudden, it has an abnormal break of 7 or 8 points.
ES rips 80 points, then another 120 the next day. Volume explodes, then it crashes 140 points in the final hour.
The next morning, it extends its reaction another point or so, and then once more starts to advance, closing very strong. But the following day, for some reason, it does not carry through.
Next session tries to recover but can't break the previous high. That's the danger signal. Livermore said,
That is an immediate danger signal. All during the progress of the move, it had nothing but natural and normal reactions. Then, all of a sudden, an abnormal reaction occurs, and by abnormal, I mean a reaction in one day of 6 or more points from an extreme price made in that same day, something it has not had before, and when something happens abnormally stock market-wise, it is flashing you a danger signal which must not be ignored.
his rule.
You have had patience to stay with the stock all during its natural progress. Now have the courage and good sense to honor the danger signal and step aside.
Livermore learned this from another speculator.
When I see a danger signal handed to me, I don't argue with it. I get out. A few days later, if everything looks all right, I can always get back in again. Thereby, I have saved myself a lot of worry and money.
Then the analogy.
If I were walking along a railroad track and saw an express train coming at me 60 miles an hour, I would not be damned fool enough not to get off the track and let the train go by. After it had passed, I could always get back on the track again, if I desired.
You don't debate the train. You step aside. And if the trend resumes cleanly, you can re-enter. Livermore knew exactly why traders ignore danger signals.
Curiously, the trouble with most speculators is that something inside of them keeps them from mustering enough courage to close out their commitment when they should. They hesitate, and during that period of hesitation, they watch the market go many points against them.
Here's what this looks like. You're long ES from 4,200. You rode it to 4,540, up $17,000 on one contract. Then the danger signal appears, but you hesitate. Why exit now? I've been right this whole time. ES drops to 4,380. You're still up $9,000, but you just watched $8,000 disappear. Then they say, on the next rally, I'll get out. ES bounces to 4,450. You're back to $12,500 profit, but you don't exit.
When the next rally comes, as it will eventually, they forget what they intended to do, because in their opinion, the market is acting fine again. However, that rally was only a temporary swing which soon plays out, and then the market starts to go down in earnest, and they are in it, due to their hesitation.
ES drops to 4,150. You're break even. Then 4,100. You're down $5,000. You went from up $17,000 to down $5,000 because you couldn't honor the signal. For prop traders, this is how you violate drawdown limits. For traders using their own capital, this is how months of work evaporate in a week. Livermore said,
Again, let me say, the human side of every person is the greatest enemy of the average investor or speculator. Why shouldn't a stock rally after it starts down from a big advance? Of course it will rally from some level, but why hope it is going to rally at just the time you want it to rally? Chances are it won't.
You're hoping the market does what you want when you want it, but the market doesn't care. Livermore told a story about distance from the market.
Many years ago, I heard of a remarkably successful speculator who lived in the California mountains and received quotations 3 days old. 2 or 3 times a year, he would call on his San Francisco broker and begin writing out orders to buy or sell, depending upon his market position.
3-day-old quotes, trading twice a year, making huge profits. Someone asked him how he could possibly track the market from such isolation. He said,
Well, I make speculation a business. I would be a failure if I were in the confusion of things and let myself be distracted by minor changes. I like to be away where I can think. You see, I keep a record of what has happened after it has happened, and it gives me a rather clear picture of what markets are doing.
He tracked patterns, not ticks.
By being up in the mountains, I am in a position to give these movements all the time they need. But a day comes when I get some prices out of the paper and put them down in my records. I notice the prices I record are not conforming to the same pattern of movements that has been apparent for some time. Right then, I make up my mind, I go to town and get busy.
The pattern broke. That's when he acted. Livermore said,
Consistently, the man from the mountains, over a long period of time, drew funds abundantly from the stock market.
the lesson: if you're watching every 1-minute candle, you can't see the danger signal. You're too close. Every normal reaction looks like a collapse. But if you track the character of the move, if you give yourself distance, you can see when the pattern breaks. Livermore ended Chapter 2 with this:
Don't let the stock go stale on you. After attaining a goodly profit, you must have patience, but don't let patience create a frame of mind that ignores the danger signals.
When you exit on a danger signal, what do you do next? Nothing. He wrote.
What I am trying to make clear to that part of the public which desires to regard speculation as a serious business is that wishful thinking must be banished, that one cannot be successful by speculating every day or every week, that there are only a few times a year, possibly 4 or 5, when you should allow yourself to make any commitment at all.
4 or 5 times per year.
In the interims, you are letting the market shape itself for the next big movement.
You're not trading. You're observing, waiting for the pattern to establish again.
Remember this: when you are doing nothing, those speculators who feel they must trade day in and day out are laying the foundation for your next venture. You will reap benefits from their mistakes.
They're overtrading, ignoring danger signals, riding trends into the ground. You're sitting still. And when the next clean setup appears, you'll have capital and clarity. He also said,
Speculation is far too exciting. Most people who speculate hound the brokerage offices or receive frequent telephone calls, and after the business day, they talk markets with friends at all gatherings. The ticker or translux is always on their minds. They are so engrossed with the minor ups and downs that they miss the big movements.
Today, that's Discord channels, Twitter, TradingView alerts every 5 minutes. Step back. Track the pattern. Honor the signals. Then do nothing until the next clean setup appears. That's Chapter 2. Markets move in patterns. Normal reactions are part of trends. Abnormal reactions are danger signals. When the pattern breaks, you exit immediately. No hesitation. You step off the tracks and let the train pass. Then you do nothing. You wait for the market to shape the next big movement. Livermore kept his records by hand. Today, you have tools that do the heavy lifting. If you're serious about tracking pattern breaks and knowing when trends are ending versus when you're just getting shaken out, check the links below. Platforms for charting, backtesting, journaling, automated analytics, psychology tools, TradeSync, and prop firm funding. If this helped, hit like and subscribe for the rest of the series. We'll break down every chapter of Livermore's book, applying his principles to modern futures trading. Order filled, helping you see the game clearly so you don't get played. Educational only, not financial advice. Futures trading carries risk. Protect your capital.